Hi, everyone. My name is Peter Krauth. I am editor of the Silver Stock Investor newsletter. It's the only newsletter that I know of that is focused exclusively on silver and silver stocks. So today I'm going to talk to you about why I consider silver to be the new silver in terms of the place to be invested now as we go forward over the next, I'm going to say, several months and years, potentially as much as an entire decade. First, we're going to talk a little bit about macroeconomics and then jump into some more specifics about silver. Something to understand about silver is that it's been used and it is being used very much both industrially and as money, as a safe haven, as an inflation protection. And so it's important to understand where we are, where we stand with when it comes to inflation. I like to look at sort of pre-COVID and now post-COVID situations. And pre-COVID, as you can see from this chart, we averaged about 1.5% inflation. You may remember that central banks were desperate almost to try and get inflation going. They kept cutting rates. We were at negative real rates for a considerable amount of time. They just really wanted to kind of kickstart inflation. And they could barely get it to 2%. Everything was very sort of slow and not sort of really taking off the way that they were hoping. But then COVID hit, as you can see with that blue line. They started printing like crazy. Inflation took off. We reached over 9% in 2022 in the US. And then things have now cooled off. We see that we've been through that first wave of inflation. Interestingly enough, the Fed still says that their target, because inflation's been high, is 2%. Yet, since COVID and since we've had this cooling off of inflation, we've been averaging closer to about 3%, and that's about 50% above their target. So I do not see inflation cooling down in any meaningful way. In fact, I think we're going to have a repeat of the 1970s when we had three successive waves of inflation, and each wave was higher, peaked at a higher level than the previous wave. And that's going to wreak a lot of trouble on the economy, but it's going to be fantastic for hard assets and precious metals in particular. This is an interesting chart that is from the University of Michigan that does some great research when it looks at does surveys of consumers and in terms of their inflation expectations. So we saw that these had peaked in sort of mid 2022, trailed downwards, and then took off actually at the beginning of this year. This had a lot to do with the tariff issues that the US administration brought in, lots of uncertainty. At one point earlier this year, the average consumer expected that 1 year out inflation was going to be as high as 6.5%. Now that has pulled back, but it's still near the peak of what we saw since COVID, which is around 5.5%. We're at nearly 5% right now. If official inflation is at 3 and we're at almost 5%, that tells you that people really do not accept, believe, live inflation from day to day at, say, 3%. They feel that we're much closer to something like 5%, and they expect that that's going to be the level as we head out a year from now. It's interesting if you look at inflation that it is what we would consider now structural. It is no longer going to, I believe, hover around 2%. I like to say that 4% is going to now be the new 2%. And there are some things when I say structural that have come in that are going to, I believe, affect inflation more permanently over the next, say, decade or so. One of them is labor power. Of course, with higher prices, labor is demanding higher wages. That feeds into inflation. Naturally, companies that either produce goods or services are going to have to adjust their pricing, pass on higher labor costs. We have the end of globalization. We now can see that the world has become fractioned. It's become deglobalized. And we are in this sort of new reality where because we can't count on the kinds of supply chain scenario that we had pre-COVID, and the world has become fractioned, and is relying on more sort of regional supplies, or what we call friendly nation supplies. Everything's become more expensive. So the end of globalization is contributing to higher prices for pretty much everything. We're still in the energy transition, so we're looking to become, as much as we can, carbon free. That is a thing that is continuing. We've seen a lot of uptake of things like solar panels, for example, wind, nuclear, and all of these things add costs. Of course, we're doing it to try to be more environmentally conscious, but nonetheless, there's a cost attached to it. And then fourthly, defense. That's part of, I believe, the end of globalization, um, with the world becoming fractioned. More and more spending is has come on around the world in terms of defense. We've seen that pretty much everywhere, and so higher defense spending, of course, feeds its way through to national budgets, and that contributes to higher costs for everything nationally everywhere. And so that's why I think that we're going to see this chart is a great representation of where I think things are going. I think we're going to start to see the end of 2% as sort of a standard expected average inflation rate, and be much closer to 4%. Now, I've been saying for about a year and a half that the big trigger for precious metals in particular was going to be when we see the Fed start to cut interest rates in the face of rising and high inflation. And we've started to see that. They had um, been cutting rates starting about a year ago in September of 2024. They paused when this whole thing with tariffs came in, but then just recently, again, we've seen them start to cut rates. They've cut again just very, very recently. And it looks like we're in the second half of this rate cutting cycle. So clearly, with inflation high and the Fed still cutting rates, really what they've said is that they're going to now sacrifice the dollar. They want to support the economy. They see that employment is starting to struggle. And even though inflation and prices for everything, goods, services across the economy are high, they're still cutting rates, and that's just going to feed another wave of inflation, like we saw that we had a peak of in 2022. Um, saying that their target is 2%, I don't believe that they really mean to try to target and get things back to that level. I believe that they've given up on it. And debts globally, especially in advanced economies, are so high. There's just simply no way that governments will manage with high interest rates, because the debt servicing becomes too expensive. So as they cut rates, it allows governments to pay less interest on their debts. It makes it more easy to deal with. And we know, for example, in the US, Trump wants a weaker dollar. It helps to boost exports, and it decreases imports. And it certainly helps to get them closer to, I wouldn't say balancing their budget, but certainly to either limit or minimize, increases in budget deficits. So we're heading, I think, towards negative real rates, and this is what I call where all bets are off and precious metals will soar. And that's what we've started to see both gold and silver sniff out this year. I think that's why we had this big run up through the summer. They saw these Fed rates coming, even though we have high inflation, and it's very, very conducive to higher precious metals prices. Something that you're perhaps not going to hear too much about is stable coins. But this is becoming a big thing in the US. Stable coins are now one of the largest buyers of US treasuries. And this is, I think, one of the reasons that we're starting to see the US administration so supportive of stable coins. They really see this as a new market for treasuries. Of course, they have to keep printing money. They have to keep issuing bonds. and there's only so much appetite for that. But stable coins seem to be this new market for bonds. Essentially, what they are is cryptocurrency that has a fixed price. Tether is the best example. It's the largest one. It's over $100 billion worth market cap, and most of their money goes into U.S. Treasury bills. And so it's like a crypto US dollar in a sense. And the idea is that this stable coin is constantly priced at 1 unit, so $1, for example. And so the idea is to have this adopted and use this stable coin as a replacement, as a crypto that would be a replacement for the US dollar over time. But there are some really, really interesting developments with Tether in particular. So Tether being the largest one, as I said, they're one of the biggest consumers, the biggest buyers of U.S. Treasury bills. But there have been some interesting developments. They have now started to shunt about 5% of their holdings into physical gold. They've said this publicly, they're looking at gold, the gold sector in particular. They're looking at putting money into gold extraction, gold refining, gold trading, royalties companies. They recently bought a stake in Elemental Royalties. That company has actually merged with EMX Royalties, and Tether has become a 33% shareholder in this new company. They've just invested over $100 million. And so this new gold royalty company is going to use that money to go out and look for new royalty assets. Um, so you have to ask yourself, what is a stable coin that is meant and mostly that is meant to mimic the US dollar and that is almost exclusively invested in US bonds and treasury bills, starting to look more and more at the gold sector and investing in the gold sector. And they've even said that they were hiring away two of the world's top gold traders from HSBC to come onto their Tether team and help them with managing their investments and their trading in gold. So very, very interesting development. Thought this was kind of fun. We talk about memes on the internet. Well, this was one that I thought would be worth sharing. Here you are, the U.S. dollar. It's now arguably we're getting this stable coin that over time may replace it. And if you look at this meme basically is saying, geez, I bought this stable coin, the US dollar, back in 2013, and now my stable coin is down 50%. Well, what that is telling you is that the US dollar, is down 50% since 2013. 12 years is all it took for it to lose half of its purchasing power. So that gives you some clue of where things are headed. So let's jump to silver. Why silver? Um, One of the big things that influences the silver market is demand from solar. Solar requires 20% of all of the silver that is brought to market every year, and we're talking the entire silver market is about 1 billion ounces. We have about 850 million ounces comes from mining, about 150 million ounces comes from recycling. And this chart is really interesting because it's the International Energy Agency's World Economic Outlook. And they make predictions about where they think, different kinds of energy demands are going to come from. And so from 2010 to about 2020, whenever they would predict, looking out over the next 5 years, how much there would be of solar installations, they were under predicting year in, year out. They were under predicting almost by 2/3. In other words, solar installations between looking 5 years out from 2010 to 2020 was 3 times on average what they had predicted. So there was a lot more installation of solar panels than the International Energy Agency was forecasting every year for about 10 years. So that goes to show you just how much there's been uptake of solar. Now, this is a really interesting chart because it talks about something that is a much more recent development, and that is demand for electricity from things like data centers and from AI. Just a sort of an interesting little note. An AI query. So when you do an AI search, that actually consumes 10 times the energy of doing a traditional Google search. So that is demanding a lot more new power that just simply was not part of our reality only as little as a 2 or 3 years ago. So if you look at, so we are generating a lot more data. We're storing a lot of this data, and not all of this is going into data centers. And over the 5 years from 2024 to 2028, the forecast is that data centers would demand 21% more energy per year for all of their processing requirements. And then you layer on top of that over these 5 years, what energy demand there would be from AI. And that is expected to grow by 33% annually for 5 years. So both of these together are going to simply explode in terms of the energy requirements for these services. And so here's where I'm going with that is that solar is going to be a huge part of that. So, yes, there's been a lot of uptake of solar, but I think that we are going to see that continue in a very big way. Tech giants, US tech giants, have looked at what kinds of energy sources they could tap into. Utilities are telling them that they should not count on them. They certainly can't generate and promise to provide the kind of power that these data centers and AI will need. And so we've seen in the past year, tech giants have adopted, when they look for carbon-free energy, they've adopted solar to the tune of 5 times the rate that they've adopted nuclear. The chart on the right here shows you the difference between solar and nuclear. So nuclear takes about 15 years to build and deploy. Solar takes about 1.5 years to build and deploy. So that's 10 times less uh, time required to build out a solar farm than to build a nuclear power plant and bring it online. And there's another interesting thing that has another development is that batteries have now become a game changer for solar. One of the reasons that these big tech companies had tapped in early to nuclear was because it's baseload power, meaning that you can count on this energy being generated from nuclear power plants to be very, very steady all day long, 24 hours a day. Solar had the disadvantage that it produced during the day but didn't produce at night. Batteries are completely changing that, and they are now making solar what we call baseload power. Um, this year, it's expected that battery installations will account for 60% of the installed solar capacity from 2023. Battery costs are coming down very quickly. They're expected to drop by half between 2024 and 2035. So again, batteries are making solar a lot more attractive. Solar, again, demands 20% of all of the silver that is produced every year. Batteries themselves consume a certain amount of silver as well. And so we're seeing even more silver required for this sort of new paradigm in the battery solar dimension. Now we're going to talk a little bit about critical minerals and so on, and how much the U.S. depends on silver. Well, this chart shows us that the U.S. requires 43 to import 43% of all of the silver that it consumes. So that means it's dependent on other countries' production of silver. That's close to half of all of the silver that the U.S. consumes has to come from other countries, from foreign sources. So that's something that, as we know, they're not necessarily comfortable with, and that's why we've seen silver actually was just added to these critical minerals list in the U.S. That's potentially a game changer, and it could bring all kinds of things. It could bring tariffs so that silver can't be exported from the US. It could bring a lot of support from the US administration for silver miners to facilitate the to streamline permitting and financing. They could to become, we've seen this with copper and lithium. They've become buyers of small companies in these sectors. We could start to see that happen within the silver space as well. So things are really changing very quickly and becoming very supportive of silver. If we look at sort of the more big picture of silver and the cost of and the value of silver versus stocks, for example, this is a fantastic chart that shows you silver versus US equities. And so when the chart peaks, what we're talking about is silver being overvalued versus US equities. When the chart bottoms, we have a situation where silver is undervalued versus US equities. So right now, that's where we stand. The last peak was in 2011 when silver had reached a peak of almost $50 very, very temporarily. And right now, even though silver is back at $50, US stocks are so expensive versus silver that we're at a bottom. And we could see that bottoming process happening right now. And that is one of the reasons that I'm so bullish on silver. I think that in particular, if you look at it versus stocks, this is just a no-brainer. Silver is cheap, stocks are expensive. Silver is the place to be, and we're starting to see this rotation into silver happen. Another interesting development that we've had recently is central banks are starting to announce. I believe that some are doing it without actually even announcing it, but that they are buying into silver. And we've seen the Saudi central bank tell the markets that they bought $40 million combination of the SLV ETF iShares Silver Trust. And a part of that went into the Global X Silver Miners ETF. So they even are now buying into silver miners through this ETF. About a year ago, the Russian central bank said it would buy silver from 2025 to 2027 for its reserves. Normally it was just gold. Now they're starting to buy silver as well. I believe they see it as strategic. And there have been some rumblings that other countries, nothing official, but that some other countries are also buying silver for their reserves. So I like to say who's next and who's already buying. I believe that's already going on. They're just not, making it public. The gold-silver ratio is something that it's one indicator that is worth watching, and it's been trending higher over the last sort of several decades, even a century or so. So since 2000, the average of the ratio was 69 or so. Before that, if you go back to 1970, it was closer to 60, and right now, the ratio is in the range of about 80 or so. And I believe that, as you'll see in the next chart, when we get to that point, then the odds are very favorable for silver versus gold, and we could start to see some tremendous returns in silver. All you have to look at is if you take even the average of the last uh, 25 years or so, 69 to 1. At $3,700 gold, you have $54 silver. We are there now. Not surprising, but I think there's a lot more exciting to come. The gold silver ratio, if you look historically going back to the 1980s, late 70s, 80s or so, typically peaked around 80 to 1. When it got above, that was a very, very bullish for silver. It often dropped very quickly. And when it got to 80, we often saw it reverse. That's those pink circles. And then it would overshoot. And by that, what I mean is that it would correct to below the typical average. We got it down um, to 48 back in 1994, 48 again in the mid 2000s. And when silver peaked at $50 in 2011, the ratio went all the way down to 32. So right now we're close to 80. I think we're going to see it in this cycle, probably somewhere around 50, 55 or so. And if very conservatively, if I use $3,700 gold, we're at 4,000 right now, and then a 55 to 1 ratio, that would bring you to $67 silver. That's a big gain from where we are now. And as I say, that's one of the reasons that I think silver can go a lot higher. This is an interesting chart that looks at what silver has done when the Fed is in a rate cutting cycle. And so silver lags gold that way. It tends to start to take off when the Fed is about halfway through its rate cutting cycle. We see silver usually bottom, typically around again halfway through the rate cutting cycle. And if you look at the average gains in silver from bottom to top in those last three cycles, silver was up on average 332%. You could argue that the low that we had in this cycle was in February of 2024 when silver hit $22. And if you get a 332% gain from that point, we're looking at $95 in this cycle. And so that's nearly a double from where we are now in the silver price, and very close to what many people are calling relatively realistic, a triple digit silver price being $100. And I think that that is something that is very much possible. We've seen the wider retail public start to come into the silver space. This chart shows you at the top, you have the silver price. At the bottom, you have how many ounces are held by the SLV ETF. And so even though the silver price went sideways, let's say from 2020 till 2024, people were not interested. They were selling their SLV ETF, so they were selling off their silver, getting rid of some of their silver. But that trend changed in the middle of 2024. We saw that bottom, and then people got in. It dropped off a little bit, but on average, we've seen the interest in silver has basically bottomed in the middle of 2024, started to trend upwards, and now we've seen a lot more interest. That means we see the general public starting to come into the silver space, and they've been buying. This is the single largest silver ETF in the world. It has billions of dollars of silver under management. And so we see that there's a lot of new interest in investing in silver, and this is one big indicator of that. So why silver stocks? I've been talking about silver, but silver stocks are a fantastic way to play this sector. The silver mining industry is tiny. It is about $50 billion. If you compare that to the gold mining industry, you add up all the publicly traded gold mining stocks, you're at about $950 billion. So the silver industry represents about 5% of the entire gold mining industry. So when money starts to flow into silver stocks, the impact is explosive. And we've seen that this year. Just one stock, for example, in my newsletter was up almost 6 times. So almost a 500% gain from January till mid-October. It's been just tremendous how some of these stocks have taken off. And again, I think this is very much early days. This is such an explosive sector because it is so small relative to even gold mining, which itself is quite small. And so when you start to see people become interested in silver and silver mining companies, there are so few names, especially quality names, for them to go into that these just explode. And we have proof of that. That is exactly what has been happening for the past 9 or 10 months or so. Here's a couple of examples from say March of last year. Silver took off. It more than doubled. This was up until about early or mid-October or so. We have the Silver Juniors SILJ, which is an ETF of junior silver stocks, and that almost doubled what silver had done from March of 2024 until about October of this year. So the leverage is close to 2 to 1. I think that we're going to see it surpass very much easily 2 to 1. Of course, there's more volatility as well, but the potential is just tremendous. This is an interesting chart that is put out by the Daily Gold. A friend and colleague by the name Jordan Roy Byrne puts out some fantastic technical research. And what he did was he looked at some of the junior silver stock bull markets going back to 2001. And these can be explosive, as I've been saying. And what he did was he looked at an average of all of these junior silver bull markets. And so the black line that you can see on this chart is an average of these different bull markets. And as you can see, we have done pretty well. If you look at, say, end of February of 2024, we've risen this much from percentage-wise about 400%, so 4 times. And yet, some of the best silver bull markets of the last couple of decades were up 16 times. Some of the largest, most conservative silver companies, silver producers, or silver royalty companies were up 16 times. So arguably, we could easily be still a 4x or 4 times the current level in the average silver stock to match the performance of some of the best previous bull markets, which were from 2000, the one from 2004 to 2007. So there's a long way to go, and this shows you just how well silver stocks can do. This is an interesting chart that shows how silver has behaved and silver stocks have behaved. It is the ratio of junior silver stocks to silver. So that shows you the leverage that junior silver stocks can give you over silver. And in 2020, you had about 140% gain in silver, and junior silver stocks had about a 200% gain. If you look back, this section here is the time from 2016 when you had an absolute explosive reaction. And yet, silver in from January until August was up 45%. The silver juniors were up 348%. That was almost an 8 times leverage of junior silver stocks, the average junior silver stock over the silver price. We just recently in the summer of this year, 2026, we've seen a breakout, and that's when silver stocks versus silver absolutely took off and offered huge leverage. And I believe this is a line that we're going to see continue to climb over the next several quarters, perhaps even the next year or two. And so the potential here is really tremendous. To wrap up, again, my newsletter is Silver Stock Investor. It's the only newsletter that focuses exclusively on silver stocks. We've taken doubles. We've had more than 7 stocks actually double in 2025 where we've taken profits. And I believe it remains still very early. There is tremendous upside still ahead. You can follow my work at silverstockinvestor.com. I am partnered with Peter Prospector. You can find all of our work at thegoldadvisor.com. It's a portal to all of our research. You can follow me on X at Peter_Krauth. I'm also on LinkedIn, and it's been a pleasure talking to you today about silver and all of the potential that we have. Thanks for listening.